can pursue capital budgeting for two reasons, right? The company might want to replace an existing asset, or the company might want to expand operations. So it's always important just to read carefully whether a company is replacing an existing machine or whether a company is just expanding its business or expanding its operations. So when you're going through a capital budgeting question, always try to ask yourself, is the company replacing a machine or are they expanding? It's just something important to note. And with time, you'll see why we ask that. Okay, so let's continue. So they are planning to replace one of their bottling machines with a newer, more efficient one. The old machine, which is the current machine they have, has a book value of 600,000 and it's got 5 years of useful life remaining. So so this machine has a book value or an accounting value or a tax value of 600,000, and they are planning to use it for a further 5 years. So just some basic low-level accounting here, just so you understand, or we can say high level because it won't be detailed. A company can purchase a machine, for example, let's say for 2 million. And then each year they reduce the value of this machine in their books. They depreciate the machine, for example, meaning they remove some value from this 2 million that they spent to show a depreciated book value. So a book value is just the cost price of the machine, how much you paid for the machine, minus the depreciation, the way you use the machine and the way it's losing value. You just need to subtract that as a depreciation expense. So when we talk about the book value, it's the cost price of the machine less the depreciation expense. Okay, I'm sure you might be familiar with that. We are told that the company does not expect to realize any return from scrapping the old machine in 5 years, but it can sell it now to another company in the industry for 265,000 Rand. So this is the proceeds from selling the machine if they had to sell it. The old machine is being depreciated by 120,000 Rand per year using the straight line method. The straight line method is where you depreciate a machine, meaning reduce the book value of a machine or the cost price of a machine by a fixed amount of depreciation each year. The new machine has a purchase price of 1,175,000 Rand. This is how much the new machine is going to be purchased for. And an estimated MACRS plus life of 5 years. Okay, and an estimated salvage value of 145,000 Rand. Right, now this MACRS that's being referred to here, it's known as the Modified Accelerated Cost Recovery System, right? It's known as the Modified Accelerated Cost Recovery System. And it's a system that's used to help to calculate the depreciation expense of a machine for tax purposes. Yeah, it helps us to calculate the depreciation expense for a machine or a capital project for tax purposes. Okay, so the way it works, it's mainly used in the United States, and the way it works is that assets are put into classes, right? An asset can be put into a class life of 5 years. It can be put into a class life of 3 years, but we usually work with 5 and 3 years for the questions that we touch upon in this module. But there are actually a number of classes of lives that an asset can be put into. So the two most common types of examples are 5 years and 3 years. So the way it works is that we make an assumption on the life of the asset. We say that the asset will have a life of 5 years, for example, or the asset will have a life of 3 years, for example. And then there are tables that tell us the depreciation expense we should apply as a percentage of the asset's cost price per year based on the class that the asset is put into. So tax authorities specify the class of life. Tax authorities specify the class of life so that companies can calculate taxes the right way. Because what happens is that a lot of financial managers will want high depreciation expenses, because high depreciation expenses reduce tax. They reduce the tax that you pay. So a lot of companies and a lot of financial managers will want high depreciation expenses so that they reduce tax. And depreciation, it's a non-cash expense. So even though you put it down as an expense, your company still has cash. So you'll find a lot of financial managers will want a very short life for the asset so that they can have very high depreciation expenses, and then that reduces their tax expense. Whereas the tax authorities would want very long depreciation lives so that the company can spread out their their depreciation expense over a number of years, thereby reducing the depreciation expense, meaning there's more operating profit for the tax authorities to tax. So here the tax authorities will guide on the number of years that an asset is given. So here we've been told they've given the asset a life of 5 years. And then there are tables for these MAC, modified accelerated cost recovery system. They are specified depreciation rates that are applied this year. And you'll notice that if it's an asset with a 5-year life, they actually give us 6 percentages. The same applies if it's an asset with a 3-year life, they'll give you 4 percentages. So these will be multiplied with the cost price to get the depreciation per year. So don't be surprised by that. So in this case, we would have a depreciation expense per year of 20%, 32%, 19%, 12%, 11%, and 6%. Okay, so that's important. And then, so these will be percentages of the cost price. And then we're told it is expected, we're told that it is expected to economize on electric power usage, labor, and repair cost, as well as to reduce the number of defective bottles. In total, annual savings will amount to 255,000. So by this company getting the new machine, they're going to have annual savings of 255,000, because this new machine will reduce electric power usage, it will reduce labor and repair costs as well, and reduce the number of defective bottles. We're also given the company's tax rate. As I said, capital budgeting cash flows has a lot of items to do with, has a lot to do with tax rates, and we're also given the weighted average cost of capital. Okay, so this is a lot of information. So this is what you tend to deal with when it comes to a capital budgeting question. So I now want us to look at a number of questions just to illustrate some of the cash flows you might be asked to calculate, and some of the questions that might come with the capital budgeting cash flow question. So firstly, we are asked to determine the initial cash outlay, which is required for the new machine. This is the initial investment. Then we're asked to determine the annual depreciation allowance for both machines, and to compute the change in the annual depreciation expense if the replacement is done. And then we are asked for the incremental cash flows in years 1 to 5. And then we're asked, should the company purchase the new machine? Okay, right. So let's get to that. I will put the solution up as I had already done it, and then I'll just explain you through the particular solution. Right. So the first thing to note is that whenever, like this is always, this applies always, whether you do your question in the exam now or you come across questions like these later on in your studies or anywhere else, always. When you are calculating the initial investment on a capital project, you take the installed cost of the new machine, right? And then you add the after-tax proceeds from the sale of the existing machine. And then you subtract, there's supposed to be a minus here, then you subtract the increase in net working capital. I'll repeat that. Whenever you are asked to determine the initial investment or the initial cash outlay on a machine or any project, you take the installed cost of the new machine, right? And then you add the after-tax proceeds from the sale of the existing machine, and then you subtract the increase in net working capital. So let me briefly explain each of these items, and then we'll see how to get them. Okay, so firstly, I've said that we take the installed cost of the new asset. The installed cost of the new asset is simply the cash outlay, your initial cash outlay on purchasing the new machine. It's simply the amount of money you spend initially on purchasing the new machine. When we talk about the installed cost of the new machine, right, we're talking about the cost price of the new machine. How much does the new machine actually cost wherever you're buying it from? And then we add any delivery expenses associated with that new machine. And we also add any installation expenses associated with that new machine. So that gives us the installed cost of the new machine. So if you purchase a capital machine for 100,000, and then you're told that delivery for the machine is 30,000 Rand, and let's say you're also told that the installation costs